Accounting is the backbone of every organization, providing a clear and systematic way to track financial transactions, measure performance, and ensure compliance. For anyone working in accounting, mastering the workflow and understanding key concepts is essential. Let's walk through these foundational principles step by step, building a thorough picture of what every accountant needs to know. First and foremost, you must understand the entire accounting process. It starts when a financial transaction occurs, referred to as a business transaction or economic event. This could be anything from purchasing supplies, making a sale, paying salaries, or receiving payments from customers. Every transaction must be documented, and this is where original source documents come into play. These original documents could be invoices, receipts, contracts, or any other proof that the transaction has taken place. Once you have the source document, you need to verify its accuracy and authenticity. This is a critical step to prevent errors and fraud. After confirming the original document, the next step is to record the transaction in your accounting software or system. This involves creating a journal voucher, which is a record that formally captures the details of the transaction. The voucher is then used to post entries into various accounting books, the general journal, the general ledger, and detailed subsidiary ledgers. At the end of each month, you need to record all month-end transactions, such as accruals, adjustments, and reconciliations. These ensure that your records reflect all activities that have happened within the period. With all transactions recorded, you move on to preparing the trial balance, which is essentially a summary of all debit and credit balances from your ledgers. The trial balance helps ensure that your books are balanced and that debits equal credits. From here, you can prepare financial statements and management reports. Financial statements include the balance sheet, income statement, and cash flow statement, which provide insights into the company's financial status. Management reports help track performance and support decision-making. Now, let's clarify some important documents. The original document, or source document, serves as evidence of a transaction. It's the starting point of any entry in the accounting system. Journal vouchers, on the other hand, are the records you create based on the source document, summarizing the transaction for posting to the books. The general journal is the book where you first record transactions in chronological order. The general ledger is the main book that organizes transactions by account, showing all increases and decreases for each account. Detailed subsidiary ledgers break down individual accounts further, tracking transactions by specific customers, suppliers, or inventory items. Every transaction in accounting affects at least two accounts. This is known as double entry bookkeeping. For each transaction, there's at least one account that is debited and one that is credited. The accounts affected fall into different categories, known as account types, numbered from 1 to 9. The sum of all debits must always equal the sum of all credits, ensuring the integrity of the books. It's also important to understand the two main sets of documents in accounting: the input set and the output set. The input set includes documents related to purchases and payments. These capture how money leaves the company. The output set includes documents related to sales and receipts. These capture how money comes in. The classification of accounts is fundamental to understanding how transactions flow through the system. Asset accounts, numbered as Type 1 and 2, represent things the company owns, like cash, inventory, or equipment. When assets increase, you record a debit. When they decrease, you record a credit. The opening and closing balances for assets are always on the debit side. Liabilities and owner's equity, numbered as Type 3 and 4, represent what the company owes or the owner's investment in the business. These increase with a credit and decrease with a debit, with their balances shown on the credit side. Income accounts, Types 5 and 7, track revenue. These increase with credits and decrease with debits. Expense accounts, Types 6 and 8, track costs and losses. They increase with debits and decrease with credits. Account Type 9 is a special category used to gather revenues and expenses for determining profit or loss during the accounting period. Each account type has its own posting rules. Asset and expense accounts increase with debits and decrease with credits. Their balances are maintained on the debit side. Liability, equity, and income accounts increase with credits and decrease with debits, with balances on the credit side. Some accounts, especially those tracking income and expenses, do not maintain opening or closing balances. They reset each period. When you complete a transaction, you need to keep a complete set of supporting documents. Typically, you store the journal voucher first, followed by the original source documents. This order makes it easier to track the flow of information and retrieve records quickly. Organizing physical files by document codes or reference numbers, especially those shown on the journal voucher, helps streamline future searches. A basic but vital principle in accounting is that total assets must always equal total liabilities and equity. This equation, assets equal liabilities plus owner's equity, is at the heart of the balance sheet and ensures that your books are in harmony. Every transaction, no matter how small, will ultimately affect the balance sheet. There are 4 possible impacts. Assets and liabilities both increase, such as when you purchase inventory on credit. Assets and liabilities both decrease, like paying off a loan with cash. One asset increases while another decreases, such as transferring funds from one bank account to another, which doesn't change the overall asset or liability total. One liability increases while another decreases. For example, converting a short-term loan to a long-term one, which doesn't affect assets. Understanding how to prepare and analyze the trial balance is crucial. The trial balance checks the mathematical accuracy of the bookkeeping process, ensuring that debits and credits are balanced. It's an essential tool for detecting errors and preparing financial statements. The financial statements themselves are the ultimate output of the accounting process. The balance sheet shows what the company owns and owes at a specific point in time. The income statement reports on profitability over a period. The cash flow statement reveals how cash moves in and out of the business. These documents help stakeholders make informed decisions. Reading and analyzing financial statements is a key skill for accountants. By interpreting these reports, you can assess liquidity, profitability, and debt levels, providing valuable insights for management and investors. In summary, accounting is not just about recording transactions. It's about understanding how each step fits into a larger system. Whether you're verifying documents, posting entries, balancing accounts, or preparing reports, every task is crucial. Mastering these fundamentals will help you maintain accurate records, support decision-making, and contribute to the success of any business.